Welcome back to yet another wrap of the monetary policy statement and the press conference. We couldn't get our experts after the press conference because of the Hyundai IPO, press event. So we just thought we should get some more experts, especially because there are some hard-hitting statements made on NBFCs, and there is this puzzle in the market as to when would be the next rate cut be. Does the stance indicate a rate cut is around the corner? With me is my colleague Ritu Singh and our guests, Umesh Revankar of Shriram Finance and Neeraj Gambhir of Axis Bank. Both are with us, and in a minute, I guess Soumyakanti Ghosh will also be there. Thank you, gentlemen. Thank you very much for your time and for agreeing to this delayed interaction. Neeraj, if I may first ask you, what have you made of the next cut? December, Feb, and why?
So first off, Latha, this wasn't my base case that we will see a change in the stance in this policy. I thought that given the fact that we will see a September inflation print of about 5% or close to 5%, and thereafter going down to 4.5%, we are still some time away. So in some senses, this is a bit of a positive surprise. What it does for the rate cut possibilities, I think it opens up the door for a rate cut, but there are too many preconditions that need to kind of fall in place for that rate cut to happen. First of all, globally, as you have seen that Fed has done 50, but the data subsequently is now leading to question marks on why they did 50. So we're still in a very unpredictable global interest rate environment, particularly in US. As far as domestically, while we expect that the inflation will steadily come down towards, say, 4.5% by the end of Q4, we still have to see that it actually happens. So I think the big conditionality in my mind is, number one, inflation steadily going down the path that RBI has estimated, or better than that. And second, from a global perspective, I think the US rate cutting cycle to follow the path that market is anticipating. If both these conditions meet, then I think somewhere in December or maybe in March, we have a possibility of a rate cut.
December or March is the possibility you're talking about, not even February. But Mr. Umesh Revankar, thank you very much for joining in here. Lots of comments coming in from the governor on NBFCs. I know he said it's not a generalized statement. There are select NBFCs that are chasing growth at any cost, charging usurious rates. What did you make of the statements? Where are you seeing these kind of outliers? And what do you think the larger message or the takeaway for you is?
Yeah, I think, I heard the comment, and also I think RBI has been consistently talking about it. It is not the first time that RBI has talked about it. Basically, I think the RBI is trying to impress on NBFCs to have a measured growth and also have some kind of control on the lending rate, because extremely high interest rates can sometimes bring in a lot of what to call credit cost, because credit cost can go out of control in that scenario. So ultimately, each of the NBFCs, depending upon the specialization or geography they are in, they'll have their own practices, and operational cost, credit cost, and funding cost will be looked into while lending the rate. Sometimes it can go a little out of control to build in a quick bottom line. So that is a possibility. But we cannot generalize that statement. Maybe there are some stray cases.
May I make it pointed? See, I look at a sentence. It is important that NBFCs, including MFIs and HFCs, follow sustainable business goals, compliance-first culture, a strong risk management framework, strict adherence to fair practices, and sincere approach to customer grievances. The Reserve Bank is closely monitoring these areas and will not hesitate to take appropriate action. They even pointed out to this sentence in the press conference. So do you think that you will also have to be prepared for higher risk weights or something like that?
No, I see it in the other way. I think RBI is trying to highlight that where the customer is not aware that interest rate charges is charged higher than what he is being told to him or what has been agreed upon, some hidden cost being added. That is something which I think RBI is trying to tell about. tell on the interest of the customers. It's more to help the customer protection and rather than trying to say that NBFCs are trying to do it as a general practice. So I think all the NBFCs
Press conference.
Are responsible corporates, and they'll definitely try to be transparent with the customer on the same.
No, certainly. And he was emphatic that he doesn't, that there are a large number of NBFCs who follow rules. These are outlier cases, he said. But even in the press conference, they pointed to the sentence as to say that depending on incoming data, we will not hesitate to take appropriate action. Just look at the governor's words, was the statement they said. So I just wanted to flag that. I'll come back to you in a minute. Neeraj, at the moment you would say life for banks becomes difficult. Both your depositors and your borrowers are in a position to dictate to you. The borrower can get, cheaper CPs or, people like Revankar can borrow from the market and you will have to bring down your rates, as well as the depositor is in a position to dictate. You think life is tough now?
I think it was a little bit tougher already. And in the sense that if you see over the last, I think 4 or 5 months, we've seen a steady decline in bond market yields. We've seen liquidity come back into the system, and that has dictated some of the money market rates. But we haven't seen as much impact on, for example, CD rates. We haven't seen the bulk deposit rates come down as much as, for example, GSEC rates have come down. So there was already a brewing mismatch. Probably that gets a bit more accentuated now with the change in the stance. But I'm hoping that as the stance changes and as the liquidity in the system continues to remain, surplus and Reserve Bank actively manages it, we will see some impact now on the CD rates and bulk deposit rates. So I'm hoping that this stance change will facilitate a bit of reduction in those rates, which were kind of holding up or proving to be a bit sticky despite liquidity stance of the Reserve Bank changing.
Well, we'll come back to that with Mr. Revankar in just a bit, but we have Mr. Soumyakanti Ghosh, Chief Economist at State Bank of India, joining in. Mr. Ghosh, quickly, your key takeaways, even after the press conference, what the governor has said on the confidence in the growth numbers, and as to when the next, pivot in terms of a rate cut are you expecting? Would that be in December, in February? What do you think the RBI is building up to?
Yeah, thank you. I think the change in stance to neutral was mostly, as per me, was dictated by financial stability consideration. Given the current geopolitical conflict which is brewing and the prospects of getting broad-based or lingering for longer, actually this change in stance to neutral will help the rest to moderate from the current level. So this is what I believe has possibly dictated the stance. Apart from that fact that growth inflation trade-off is also delicately poised. The point I should like to mention over here is that the central bank looks very confident about growth numbers. This year, the growth number is at 7.2%. Next year, it at 7.1%. Even on the inflation front, it sees some minor jumps in the midterm. Basically, this month's inflation number could be around 5.3 to 5.4%, and next 2 month inflation number could be also around 5%. So my sense is that this policy statement of changing to neutral has been more often dictated by forward-looking considerations of inflation coming down to around 4%, which is the projections for next year. But as of now, the most important thing to note is that maybe possibly for the first time, we'll be embarking on a rate cutting scenario when the growth has been so strong. And this is one of the fundamental differences which has been happening recently. Even central bank like Fed has cut rates when the growth rate in US economy has been close to 3%. So possibly the resilience of the economy post-COVID we share in a scenario where you can see that the central bank cutting rates even when the growth rate is so strong as per their projections.
Okay, fair point. There is a small part of the economist community which believes that probably the Reserve Bank will be convinced of more slowdown when the second quarter GDP numbers come in and other data for Q3 come in if the festive season demand is not as good. And then they will use that as a pretext to cut. Probably in February. I mean, there's a group of people who think that way. But Soumya, I agree with you. There was a certain emphasis and what do you call it, confidence in the growth arguments. So and last time they were proved right, weren't they? They were sitting at 7 and everybody else had to correct their numbers to the Reserve Bank's number. So I take your point on that. Neeraj, any other way life changes? Do you think life gets tougher when the LCR rules are called? Any other takeaways from the policy?
There is nothing on the LCR rules in this policy, so there's no clarity as to whether the enhancement of the runoff factors for retail deposits, the internet banking and mobile banking driven retail deposits, when does that come into play? That is going to be a significant impact on the industry because the amount of change that entails in terms of banks holding of government securities is fairly large. Our estimate was about 2.5% or thereabouts of NDTL. So when will that change kick in and by what extent and what will be the timelines in terms of implementation? I think that remains a key, I would say, uncertainty at this point in time. And as and when that becomes clear, I think the markets, markets view will also sort of play out. This will have also an impact on the government bond demand in the system, right? So you could see some impact of this on the way the yield curve actually plays out. Besides that, I think for us, liquidity remains a major monitorable. While the system liquidity is good, the banking system liquidity is something that remains, that kind of fluctuates depending upon government expenses. So, so far, Reserve Bank has done a very proactive management of this, and I am hoping that process will continue.
Well, there was one more guess in the market, but I don't have time to discuss that because you have shifted your stance to neutral, the way you give liquidity also will be more rather than less. I mean, to put it in Dr. Reddy's terms, it won't be appropriate liquidity. It may be adequate liquidity. A little more than, no?
I would like to argue that the change in liquidity stance was a precursor to change in the policy stance. Okay. So effectively, they had done that before.
All right. So, okay. So we can't be that optimistic. Very quick question. We're being asked to wind up. Umesh, Revankar, life is good now, right? Because your borrowing cost will fall after this fall in yields. Maybe it will get tough if they announce any risk weights. But at the moment, you're in a better place than you were before the rate cut, before the stance change.
Definitely, yes. I think the capital market will definitely be more favorable. We will have an option of raising more from the capital market, and that will help us. But I think going forward, the way the RBI has talked about the current situation, macroeconomic conditions, I think it looks as if with a good winter Rabi crop coming in, I think it looks like it is going to be the rate getting better and better for NBFC. So, and that will help us to pass on that benefit to the customer. Ultimately, the customer has to be benefited by the action of the RBI or from the finance industry. I think overall, I feel it will be good for the credit growth going forward.
Okay, that's a very important statement, and that may make life a little more difficult for banks if they have to pass on a rate cut, but their own cost of money is not going to fall very quickly. Thank you very much, gentlemen. Out of time, but not out of questions. But we've got some very good takeaways from you all. Life is still tough for a banker. For an NBFC, at the moment, life has gotten a little better because the cost of money which they pick up from the market is a tad cheaper because of the overall fall in yields. But there is that sword hanging of a possibility of higher risk weights. From the economists, the key message is the Reserve Bank's tone on growth is unmistakably optimistic. But it's good for all of us, isn't it?
Well, it is. And now on to the next policy in December, or perhaps February is when we'll see that big change that the markets are predicting. But
before that, we will all be nosing around on whether the same man continues. From the looks of it, we hope he will. Thank you very much for joining us in this special monetary policy check. We have to take a break, and after that, it will be time for your stocks.